All right, so to summarize what I just said, the US market is expensive, but bullish momentum is likely to push prices moderately higher in the short term. So I expect 2018 prices will continue going up, not tremendously, but moderately. Okay. So again, this is driven by positive economic data. The Fed will continue to tighten interest rates. In fact, they project 2 interest rate hikes in 2018. And we've got a pretty pro-business government with the Trump administration in charge. So what are the sectors and industries that I expect are likely to outperform in 2018? First of all, once again, healthcare. I expect healthcare to outperform because of innovation breakthroughs and the fact that there's a huge aging population in the developed world. So huge opportunities in healthcare. So you could buy, again, the individual healthcare stocks through analyzing individual companies that we teach in the Wealth Academy programs. We teach you to pick these stocks. Or you can buy the ETF, a collection of healthcare companies. The healthcare ETF is known as the XLV. Okay. Next, technology will continue to do well as always. And the big themes in technology will be e-commerce as usual, robotics, and artificial intelligence. So that's where I'm putting my money in. Again, you could buy the individual companies or invest in the sector industry ETFs. For example, the robotics ETF, Robo, and the online retail ETF, which invest in online e-commerce companies like Alibaba, Amazon, and so on and so forth. Next, with banks going to, again, with a bank deregulation from the Trump administration, we expect bank earnings to continue to grow and benefit from rising interest rates. So again, you could buy individual banks like Citigroup, Bank of America, or you could simply invest in the bank ETF, the KRE. There's going to be infrastructure spending based on, again, the Trump administration. So we're looking at global infrastructure ETFs to benefit from infrastructure spending. Next, with, again, geopolitical tensions, uncertainty in the world, terrorism, as always, I put my money on defense stocks. Aerospace and defense companies like Lockheed Martin, Boeing, or simply investing in the ETF, which is the ITA. So let's take a quick look at some of the charts of the ETFs that I am looking at. So this is the XLK, which is the technology ETF, which is basically a portfolio of all the technology companies in the US markets. And you can see it's on a very clear uptrend, and I'm riding the trend up on the XLK. This is the online retail ETF. So this ETF invests in the online e-commerce companies. Again, a very nice uptrend. I expect this to continue going up and making good returns for investors. Next, we have got Robo, which is the global robotics ETF, where you invest in robotics companies. So I don't know about you, but I see that robots would eventually take away a lot of jobs and be a main feature in most industries like healthcare and retail. Okay, so by investing in this ETF, you're investing in robotics companies and you're riding the trend in robotics all the way up. And again, you can see very nice time to buy is when it dips on the moving average. Bounces and you buy and you ride the trend up. These are more for medium to long-term investments, of course. Okay. Next, this would be the healthcare ETF, which is the XLV, which tracks, again, healthcare stocks. Very clear uptrend, as you can see, riding the wave that way. So good time to get in while it's near, again, a retracement of the uptrend. This is the ITA, which is the US aerospace and defense ETFs. Again, with more terrorism, with more uncertainty in the world, more spending on defense, aerospace, and again, you can see this ETF is on a very, very clear uptrend. Good investment to make in the medium to long term, buying again when it's near the moving average, catching the trend up. Finally, let's take a look at KRE, which is the regional banking ETF. And again, this ETF is invests in a portfolio of regional US banks. And again, you can see over here, it started a new uptrend there. So it's a very nice pattern to actually enter based on the technical chart patterns. Oh yeah, one more chart to look at would be the IGF. This is the Global Infrastructure ETF that again invests in infrastructure companies, which again I believe will do well riding the infrastructure spending wave in the US. Currently you can see it's on a clear uptrend over there, and right now it's in a bit of a consolidation pattern. So I'll wait for a break of the consolidation pattern to take an entry over there, or you could simply buy at the support level over here as well. There'll be a good entry point for the IGF. All right, so that's the US markets. Let's talk about Asia. So I believe that Asia and emerging markets will do even better than developed countries like the US and UK in 2018 and beyond. Why? Because Asian and emerging markets are showing even stronger growth at reasonable valuations, which means the markets are still pretty cheap. So what are the emerging markets that I believe will outperform? Would be Hong Kong. I'm really bullish on Hong Kong. Vietnam. Really bullish on Vietnam. I love Vietnam. I go there very often. I conduct my courses there as well. So I know the people. I'm really bullish on Vietnam. India. Love the food there. Have not been there for quite a while. And South Korea. As long as it doesn't get into a confrontation or conflict with North Korea, things should be fine over there. Okay. So where's the opportunity in these emerging markets? Well, again, the opportunity lies in, again, fundamentally very good companies. So you got to invest in the fundamentally good companies in these emerging markets, or simply buy the emerging markets ETF that will invest in a portfolio of the best companies in those markets. Now, especially, I think there's a lot of opportunity in the small cap plays, which are the small companies, because a lot of the rallies, a lot of the price increase has come from the large caps in 2017, right? The big companies. So I would look to put a lot of investments in the small caps of emerging markets in 2018, especially technology stocks in Hong Kong and China. So again, how could you invest in emerging markets? Well, there are a few ways you can do it. Well, first thing is get a broker, a stockbroker, that allows you to invest in many, many markets. So the broker I use, it allows me to invest in 22 countries. All right, so if you want to know about my broker, you can send me an email. I can share with you about the brokers I use and can use the same stockbroker. So number one, you could invest in individual stocks in individual markets. So you could invest in specific companies in Hong Kong or Vietnam or Korea. But to do that, you have to do individual stock analysis. And I teach my students exactly how to do that in the Wealth Academy program, my live training I run in Asia. If you don't like to go into all that hard work, you could simply just buy the individual market ETFs. So you could buy the Vietnam ETF, okay, or the Hong Kong ETF, or the India ETF. And these ETFs are listed in many markets and in the US market as well. So you could buy emerging markets ETFs listed on the US markets. Finally, you could also invest in ETFs that invest not in a single market, but in a collection of emerging markets. So some of the ones I've invested in would be the EEM. The EEM is the Emerging Markets ETF. So this ETF invests in a variety of emerging markets, which I'll show you in a while. Next, I also invest in a BKF, which is the BRIC ETF. BRIC stands for Brazil, Russia, India, and China. So this ETF invests in these four markets. And you can also look at the EEMS, the Emerging Markets Small Cap ETF, that specifically invests in small cap companies in emerging markets. So again, let me emphasize that this is not a recommendation to buy these ETFs because I'm not legally regulated to give financial advice. This is what I've bought, this is what I'm buying, so I'm just sharing this purely for educational purposes only. Please do not buy it until you do your own research or to consult a financial advisor. I have got to tell you this, right? So it's not a recommendation, but that's what I'm putting my money on. So this is what I bought, the EEM. In fact, I bought it many years ago, and I keep reinvesting in it, dollar cost averaging as the trend goes up. This is the emerging markets ETF, where you can see it's been on a very clear uptrend. So I keep buying whenever it's near the moving average, and I keep riding the trend up. And eventually I'll get out when the trend ends. When it reverses in a downtrend, I'm out. So for now, it goes up. So this ETF invests in emerging markets like Indonesia, Poland, Brazil, China, Russia, Thailand, all into one, right? And it's listed in the US markets, right? This is another one which I'm invested in. Disclaimer, I've invested in all these ETFs. This is the BKF, the BRIC ETF, Brazil, Russia, India, China. So again, very nice uptrend, been buying it as it dipped on the uptrend. So always wait for the dip, never buy the high, all right? This is the EEMS. I think I showed you this, sorry, it's a duplicate. Yeah, the EEMS, the Emerging Markets Small Cap ETF. So this ETF specifically invests in the small companies in emerging markets, which again, I believe would outperform the large caps in 2018. Because 2017 was where the large caps did perform well in. So I've talked a lot about growth, I've talked a lot about markets on an uptrend and all the rosy stuff, right? But a question on many people's minds, and even on my mind, is what is the probability of a market crash? What is the probability of a recession hitting us unexpectedly? So now understand there's always two schools of thoughts, right? No one can agree where the market is going. So that's what makes the market exciting, So there are always two schools of thoughts. And one school of thought is an argument that, a recession is going to come anytime. Why? Because a recession is overdue. We normally have a recession every 10 to 12 years. And the last recession was 2007, October. Now it's 2018, it's more than 10 years, we are due for a recession. That's one argument. Next, valuations are stretched. Markets are too expensive. They gotta crash, you gotta come down. What goes up must come down, right? And next, a lot of people believe that stock prices are propped up artificially by cheap money, by low interest rates. So eventually when interest rates rise, the whole thing will crash like a deck of cards, like a house of cards, all right? So that's an argument that recession's coming, don't invest, buckle up and put your money in cash or buy gold, right? That's one argument, right? The other argument is against a recession. I say, you know what? There's no way a recession is going to happen. Very low probability, because the probability of a recession does not increase with the length of a bull market. It doesn't mean that just because the bull market is very long, that the uptrend has been up there for a long time means that a recession is coming. It's like when you play roulette. It doesn't mean that with 10 reds in a row, 10 red numbers, it doesn't mean that the chance of a black is higher. That's called the gambler's fallacy, right? Every time the probability of landing on a black or red is still 50-50. Okay, it doesn't mean after 10 blacks you're going to get a red. That is a fallacy, okay? The other reason why a recession is unlikely is because unlike the financial crisis, unlike the dot-com crash, corporate debt levels and consumer debt levels are not excessive. Okay, in fact, debt levels, leverage levels are pretty low historically. And it is coupled with very strong global earnings growth. And the treasury yield remains bullish. Okay, for those of you who study economics, the treasury yield shows you basically short-term interest rates and long-term interest rates. So these are interest rates. So in a normal economic environment, long-term interest rates should be higher than short-term interest rates, right? In fact, if you put your money in the bank for a long-term fixed deposit, you should get higher interest rates than putting in the bank for a short-term period of time, right? That's a normal yield curve. We call this the yield curve, right? But whenever you see an inverted yield curve, which means like that, which means short-term interest rates are higher than long-term interest rates, that's called an inverted yield curve. That is so-called the what's the word for it? I wouldn't say prediction. It is kind of like the anticipation of a recession. All right. So The question would be this: how do we anticipate a recession before it happens, and how do we exit early? I'm going to show you how I do it right now and how I've anticipated the last 3 recessions as an investor. Now, the mistake a lot of investors make is that they fear a recession, so they stay out of the market and they miss these big runs, which is what has been happening in the last few years. Because every year, people keep predicting a recession is going to happen this year, and people do not dare to invest, and they keep missing out on great returns in the market. So that's the first thing you should not do. Never stay out of the market because of the fear of recession. Because like I said, no one can predict when exactly a recession will happen. The other mistake that people make is that they may enter the market and they only exit when a recession hits them. And by that time, it's too late, because the moment the recession has happened, stock prices would have already fallen by 25 to 50%. So what you got to do is you must learn how to read the leading indicators to a recession and exit just before the recession happens. So what are these leading indicators? Now again, we can't predict with 100% certainty. No one can predict the future. But these leading indicators give us a very high probability of knowing when to exit the markets. All right, so I'm going to show you 2 of my leading indicators of when to exit the markets. The first leading indicator is to look at, again, the yield curve, which I just talked about. Whenever you see the yield curve inverting, in other words, the short-term interest rates are higher than long-term interest rates, that's the time to exit the market. So if you take a look at this chart, it shows you over the last 60 years, when did the yield curve invert? All right, so now if you take a look at this green squiggly lines, can you see these green lines? Okay, that is the Treasury yield curve, 10-year minus 3-year yield. So what it means is that when this green line goes below 0, can you see this is the 0 line? When it goes below the 0 line, which is here, okay, whenever it goes below the 0 line, it means that the 3-month interest rates is higher than the 10-month interest rates, which means that the yield curve has inverted. And you can see that every time it has happened, it has coincided. See, can you see when it went below 0? This is the stock market. This yellow line is the S&P 500. Every time it happened, the market would crash. 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 So I'm constantly looking at this chart, at the yield curve. The moment the yield curve inverts and this green line goes below the 0 line, you got to get off the market. All right. So currently, where are we? Currently, we are here. Okay, can you see? We are right now here. We are not below 0 yet. So I'm looking at this every single day. And as my student, I'll tell you the moment it happens, sell everything, get out, right before the crash. I can't predict for certainty, but I can tell you for the last 3 recessions, it's been pretty accurate. All right, guys? Next, you got to understand that by the time the recession actually happens, it is too late to get off the market. You have to get off the market before the recession actually happens. So let me explain to you the relationship between the economic cycle and the stock market cycle. Okay, the economic cycle is measured by GDP, and it's the green line. Can you see the green line? So the green line is the economic cycle. The red line is represented, or represents, the red line represents the stock market cycle. So notice that the economy and the stock market, they do not move together. Okay, in fact, the stock market moves 6 to 9 months ahead of the economy. The stock market is a leading indicator of the economy. So this means that when a stock market goes into a downtrend, 6 to 9 months later, the economy will go into recession. When the stock market reverses into an uptrend, 6 to 9 months later, the economy will register a recovery. Okay, so let's take a look at the chart, and let me explain what I'm talking about. So you can see over here, over here, that is known as the market top. All right. Again, the red line is the stock market. So that's the top of the market. Can you see that? Now, over here you can see the market has reversed from an uptrend into a downtrend. So how would you know when the trend has reversed? By looking at the chart patterns, the moving averages. From making higher highs, the price now makes a lower highs. And again, this is what you will learn in detail in the Wealth Academy program and even in the online courses I teach to know exactly when the trend changes. Now notice, as the market is going down, as the red line is going down, notice that the green line, the economy, is still going up. Okay? So in other words, you have to start selling over here. You have to start selling the stock while the economy is still going up. Because if you wait for the economy to go down, can you see the green line is going down? This is known as a recession. Can you see the word early recession here? That's right. By the time the economy goes down, the stock market, which is the red line, would have already fallen by more than 50%. That is why most investors, by the time they sell in a recession, the market's already dropped 50%. They've already lost half their money. Does that make sense? At the same time, look at this. This is known as the market bottom, where the market's at the bottom. So this is where the market starts a new uptrend over here. That is exactly when you should buy. You buy when the market is still in a recession because the stock market moves before the economy. And how do you know the market has started a new uptrend? Again, by looking at the price action on the stock charts and the moving averages, which is again something that you learn in detail in my trading and investment courses. Okay. The trouble is many people, they only buy during an early recovery, which means they wait for the green line, the economy, to start growing. Now the trouble is the moment the economy starts going up, you can see that the stock price, which is the red line, has already risen by 80%. And that is why most people tend to buy near the high and sell at the low. So you never make decisions based on purely looking at economics and GDP. It's always a lagging indicator. You must always make decisions based on stock prices, price action. That's why technical analysis is superior to fundamental analysis. Okay? So in fact, the last recession was the financial crisis, October 2007. And I was able to get out right before the recession by looking at the market trend. So for example, this is the Dow Jones index, and you can see that this was October 07 when the market started making lower highs. Okay, you can see over here from this high, lower highs, lower highs, lower highs, lower highs, lower lows, lower lows, lower lows. And you can see the 50 moving average crossing below the 150 moving average. That is an indication when the 50 is below the 150 moving average and the moving averages are sloping down. That is a signal of a clear downtrend. This is exactly the point you have to sell and get out of the market before the market crashes. Okay, so that's exactly what you learn in my courses, and I'll teach you exactly when to get out, when to get in as part of my service to you as an investment coach. Now, finally, let's talk about cryptocurrencies. I can't leave talking about outlook and opportunities without talking about the rise of Bitcoin and cryptocurrency, something that everyone's talking about. So, cryptocurrencies are seen to be an alternative to fiat currency. Fiat currency would be paper money, the US dollar, the Japanese yen, the euro. So the question would be, will cryptocurrencies, Ripple, Bitcoin, Ethereum, eventually replace global currencies? Well, you never know, okay? And cryptocurrencies are looking to massively disrupt the financial industry as consumers in the future can transfer currency without going through banks and financial intermediaries. So if you think about it, it's kind of like how WhatsApp has disrupted the telco industry. So with WhatsApp, we're able to send messages, we're able to call each other without going through the telcos, right? So WhatsApp has disrupted the telco industry. Similarly to how Amazon, Alibaba has disrupted the retail industry. So there's a belief that cryptocurrencies and Bitcoin will disrupt the financial industry. Because with Bitcoin and cryptocurrencies, we can now send money to each other without going through the banks, without paying the bank a fee for handing out money. And we can transfer money instantaneously without being held in the banks. Now, like everything else, like every new technology, there are two schools of thought. One school of thought is that cryptocurrencies and Bitcoin are a big scam. It's a Ponzi scheme. It's going to blow up. It's going to collapse, right? In fact, Jamie Dimon, the CEO of JP Morgan, says, if you're stupid enough to buy Bitcoin, you'll pay the price one day. And that's what some people think. It's a big scam. It's going to collapse, right? But I don't blame them because many of these bankers are scared shitless. They're afraid that if this comes true, banks could lose a lot of money. They get disrupted by cryptocurrencies, okay? Now, on another school of thought, there are people who believe that cryptocurrencies, Bitcoin is here to stay, is going to change the world. Just like WhatsApp and Telegram is changing everything, right? And this guy, John McAfee, who is well known for his antivirus software, he said, when I predicted that Bitcoin would go to 500,000 US dollars by the end of 2020, it used a model that predicted 5,000 at the end of 2017. But as you know, Bitcoin at end of 2017 has hit $20,000. So he said Bitcoin has accelerated much faster than my model assumptions. So I now predict that Bitcoin, misspelling to him, he now predicts that Bitcoin will hit $1 million by the end of 2020. I will eat my dick if I'm wrong. So you got two schools of thoughts, right? One is that Bitcoin is going to go to $1 million. One is Bitcoin is going to collapse, right? Now I got to admit, when I first looked at Bitcoin, I thought it was a scam. I said, you know what, it's going to collapse. It's going to go to zero. But after doing a lot of research and investing in cryptocurrencies myself, I'm kind of like having an open mind right now. Now, it could still collapse. You never know, right? But I believe that it could be here to stay. So I'm investing about 5% of my portfolio into cryptocurrencies. So if the worst happens and it collapses, I lose 5% of all my money. But if it really turns out to change the world, I could make a lot of money. So I'm kind of like betting 5% and let's see what happens. So cryptocurrency is kind of thing where I'm betting $1. If I lose my dollar. Fine. But if I win, I could make $10 or $20 or $100. All right? So that's the thing about Bitcoin and cryptocurrencies. So if you take a look at Bitcoin, from the start of 2017, it's been crazy. It went from $850 to a high of $20,000. And now you can see it is making a nice retracement to the 50 moving average at about $14,000. So I started buying. Now I had my cousin, his name is Yu Jun, he bought at $200. At $200, so the guy has made so much money, right? I went in late. I started buying Bitcoin at about $3,800. So I bought it here. And as it went up, I continued buying during the dip on the uptrend, and I continued buying more recently at $14. So I bought along the way, and I believe it's here to stay, right? Whether it go to $1 million, I don't know, right? But it should go to at least $50,000 to $100,000 in the next couple of years, okay? This is Ethereum, which is another cryptocurrency which I invest in. I went in at about $300. So I bought it at $300. It's now at about $1,000. Tripled my money, but again, I've got some friends who went in at like $14, who went in at $6. All right, so you never know, and it could still go higher, basically. So if you watch one of my videos on YouTube, you know that my short-term target for Bitcoin is $25,000 by 2018, and eventually $100,000 in the next 5 years. Whether it's going to go to 1 million, I don't think so. I don't know, right? But at least 25 in 2018. Again, I'm not going to bet the farm. I'm just going to put 5% of my portfolio and let's see what happens to that. But bear in mind, if you invest in cryptocurrencies, it is not for the faint of heart. Okay, cryptocurrencies make stocks and forex look like fixed deposits because it's extremely volatile. It can go up by 30% in one day and crash by 40% in one day. So if you take a look at Bitcoin over the years, the average decline has been 45%, 39%, 76%, 94%, 34%. So you got to have a very strong heart to ride this roller coaster, you know, if you want it to go up, right? So just put whatever you can afford to lose, close your eyes and don't look at it, and it's right it up. If it goes to zero, fine, you know. Don't bet the farm on it. That's what I'm saying. So let me summarize everything I've talked about for 2018. So here's my forecast. I'm moderately bullish on US equities. Like I said, I believe the US market will continue going up moderately. Although valuations are high, growth catalysts should again give the bull run more room to run from now. Very similar to my 2017 forecast. Now again, this is really based on momentum style investing and not value investing style. If you're looking to buy undervalued companies in the US, you can't find any because everything is not cheap anymore. So it is kind of like a momentum market. You know, buy high, sell higher, and ride the momentum, ride the trend as it goes up. And you got to exit the moment the trend reverses. And I'll tell you exactly when it happens. As my student, you will know yourself as you come to my courses. I'll focus on certain industries and sectors, like I mentioned, healthcare, technology, robotics, online retail and e-commerce. Financials, especially banks, global infrastructure, and defense and aerospace. I'm very strongly bullish on emerging market equities, especially Hong Kong, India, Vietnam, and Korea. Again, I have invested into the emerging markets ETFs, like the EEM, BKF, and EEMS. I'm cautiously bullish on cryptocurrencies. I believe they could change the world, putting a small portion of my portfolio in cryptocurrencies, not betting the farm, but enough to make myself very wealthy if it goes up. Again, it could disrupt the financial industry, so good to have some bets there to hedge your normal financial bets. Okay, now I'm bullish on the US dollar in 2018. I think that it's oversold. It should bounce back up, not very strongly, but moderately. And as the Fed increases its interest rates 2 times in 2018, that should give some strength to the US dollar. So those are my summary for opportunities in 2018. So knowing all these things, how do you profit from the markets? How do you invest? You may say, Adam, so based on what you're saying, what should I buy? Exactly when should I buy? When should I sell? How much should I buy? How should I manage my portfolio? How much do I put into each asset class? Well, it really depends on you as an individual. And that's why in my Wealth Academy programs, I teach you a variety of techniques, from long-term investing to medium-term investing to short-term swing trading to intraday trading and scalping. And you got to use a style that fits your lifestyle and your personality and your capital. All right, so you'll be learning different styles in my Wealth Academy live training courses that I conduct in Asia. Okay, so one way is to use a long-term approach where you invest regularly into the markets through dollar cost averaging, and you should only do that on indexes, ETFs, and fundamentally strong companies. Okay, which means you buy and hold over the years. Or you can do a medium-term trend following, which means you invest only as the trend remains on a clear uptrend, and you buy when it's near the moving average. Okay? And you have to sell the moment the trend changes. All right? So I'll teach you the exact entry and exit rules for medium-term trend following. You can also be a short-term swing trader for quick income in the markets. So you're in and out very fast to capture quick income in the markets, both the stock markets and the forex markets, which I trade in. So in short-term swing trading, it's about quickly buying there, selling there, buying back here, selling here, right? So on and so forth. Swing trading means in and out within a few days or 1 or 2 weeks. So that's what I do in my Piranha Profits, as well as Wealth Academy professional courses. Finally, in my courses, I also teach intraday trading, where we look at 1-minute candles to 15-minute candles, and I trade intraday on forex and stocks, where you can see that this is 1 day. These are 1-minute candles where we quickly enter the market over here, for example, as it bounces off the moving average. we exit at a high, we take a quick profit within a few minutes. Every day, in and out, making some good income to supplement our main job. And that allows you to generate more income for yourself and grow your wealth over the years for you and your family. So, if you want to find out more about our courses, you can go to wealthacademyglobal.com to find out about our Wealth Academy and Wealth Academy Professional courses that are run in Singapore, Malaysia, Vietnam, and Philippines, where we focus on stocks, CFDs, and forex trading. I teach you investing, swing trading, day trading, and scalping. For those of you who are far away in the US, in Canada, in Africa, we have our Piranha Profits, which is our online professional stock trading and online professional forex trading courses, where again I teach swing trading, day trading, and scalping. So all these are meant for you to help you, to empower you with all the skills and strategies to really succeed in any market condition. So this is Adam Khoo signing off. I hope you enjoyed this video. If you did, please subscribe to this channel, watch more videos, and may the markets be with you in 2018 on the long side or the short side for the rest of your life. Thank you guys, and I'll see you soon in my courses. Once again, if you like this video, do click the subscribe button below to subscribe for more upcoming videos. If you like to view our programs, do go to wealthacademyglobal.com for live training in Asia. Or for international students, go to piranhaprofits.com. I'll see you soon. Take care. All the best for 2018.